All right, now we're joined by Dartmouth College economics professor and former Federal Reserve Board special advisor Andrew Levin. Nice to see you again, sir. First, your reaction to the decision by the Fed and the language.
Yeah, I think that what's great about the Fed's communication is they have the statement, which almost zero changes today. There's literally like two words that are minor. Of course, the actual change in the funds rate. But what's important is the new projections that they've released and some pretty notable changes since September. What I would emphasize here, and somewhat distinct from the previous guest that you were speaking with, is I see the risk in a different direction going forward. The latest Atlanta Fed assessment is that GDP for this quarter is going to grow at around 3%, which is well above the kind of normal sustainable rate. Unemployment rate's still low. Jobless claims will get a new batch tomorrow, but they're still running very much like normal. The financial conditions have eased a lot. What I think could happen over the next 6 months to a year is the economy continues to be pretty robust and resilient. Business fixed investment continues to expand. Retail spending holds up pretty well. And in that world, workers still want cost of living increases. Nominal wage growth can continue high. And that's going to lead to continued pressure on prices in the service sector. So what the Fed's alert to, I think you can see it now in their dot plot, is they got a ways to go. There's a benign case where inflation comes down a lot next year, not just in goods, but in the service sector and in nominal wage growth. But I think the scenario investors should be alert to is the possibility that even going above 5% isn't enough, that the economy is going to more or less continue humming along next year, and that it's going to turn out the Fed has to go further.
So, Andrew, how much further then do you think the Fed is going to have to go? If 5.1% isn't high enough, how much higher do you think is necessary?
Well, so the Cleveland Fed has a new survey of inflation expectations of consumers. They asked ordinary people kind of how much of a wage increase would you need over the coming year in order to compensate you for the cost of living? And the answers in those surveys are on the order of 7 to 8%. That's pretty consistent with some other measures too. The nominal wage growth is very strong right now, 3 percentage points above the pre-pandemic levels. So if you ask me, where does the Fed need to go if the economy continues to be strong next year? I'd say 6, 7, maybe more. We'll see. We're in uncharted waters here in the wake of the pandemic. So we should be really careful here just to recognize that there's a lot of distinct risks, and we should be alert to those risks.
I just want some clarity. You don't think the Fed will go to 6 or 7%, do you?
I think there's a very good chance of that. In fact, I will tell you, a year ago, I was on this program at a time when most professional forecasters and market investors thought the Fed would only hike once or twice this year. And I said a year ago that I thought they might have to go up to 3 or 4 or more. And you and your colleagues were kind of in shock. And I think, but looking back, it was clear the risks were to the upside. So I just want to say again here, we'll look forward over this coming year, and they could go in the other direction. But right now, I don't see the risk of recession as nearly as significant as the possibility that the services inflation continues to be far higher than the Fed's target.
We'll check the tape, man. We believe you absolutely, Mr. Levin. But I'm curious, there are some who feel the Fed may be forced to call it a victory around 3.5% to 4%. Do you think that's possible?
I think if inflation stays high for another year, and high here could be 4%, that would still be twice as high as their target. Then we get into a presidential election year, and the Fed's going to be in a tough spot at that point a year from now. Are they going to be willing to tighten a lot further and potentially cause a recession in advance of a presidential? That would be a really tough decision to make. So the possibility that this gets further and further entrenched for the next several years is definitely part of the concerns that I have.
So, Andrew, where do you stand then on the labor market? How much job loss or weakening we need to see on that front, if any, in order to get inflation under control and to be in a better position than we are today?
Okay, that's a great question. And I think one thing that's important to recognize is that when the job market's growing steadily, and right now, the what we call prime age workers, which are people in their but 25 to up to around 55 or 60 years old. Most of them are back to work now. The ones who were working before the pandemic now, most of them are back to work. In that sort of environment, we shouldn't be expecting to see job growth of 200 or 300 or 400,000. The normal kind of job growth that you need to have to sustain the labor market is probably more like 100,000. So my expectation is we should and almost have to see job growth declining over the next 6 months, 9 months to around 100,000. And we should not view that as a tightening of monetary policy or a sign of a recession. It's just going to be the normal pattern of, at this stage of a recovery, what happens to the monthly job numbers.
What would you like to hear from the Fed chair today?
If he keeps reinforcing the message that they're not done and that they're willing to do what it takes to bring inflation back, they got to be careful. They ideally would like to avoid a recession, or at least a severe recession. They should take a balanced approach to both parts of their legal mandate, maximum employment and price stability. But given that services inflation is heading still in the wrong direction, we need to hear from Chair Powell reinforcing, underscoring that commitment month to month to month to month until we really see progress on this.
Andrew, when it comes to raising rates, how quickly the Fed could potentially do that? You said that maybe we'll see somewhere around 6 to 7% outside, or I guess looking ahead to next year, the next Fed meeting. Are you expecting another 50 basis point hike, or how do you see them getting to that potential 6 to 7%?
I think that's a good question. So they're alert to the data coming in, and some of the data around the holidays is harder to read. But I think that probably it would make sense for them to make another 50 at the end of January, given what they've just shown in their dot plot today. I think if they didn't do another 50, it might undermine their credibility. But going forward beyond that, they could start moving to 25s. Or if the service inflation data continue to come in stronger and the nominal wage growth going into the new year looks like it's picking up, even accelerating, then they'll have to keep doing 50s for a while. And again, the communications here is really critical to keep updating the public and the markets how the Fed sees all of this.
Andrew Levin, always great to have you. We're going to have you back here in order to follow up on today's projection. You were right last time. We'll see if you're right this time around. Thanks so much for joining us this afternoon. All right.